Thanks everyone for joining us this morning. We've got, I think, quite a broad and interesting group of gentlemen here who come at mine finance and project finance from different perspectives in different regions and different areas. Basically, I'll just go through each of the gentlemen and ask them to introduce themselves and give us a little short description of the areas that they work in with regards to project financing and early stage or whatever it might be that you get involved with. Mark, maybe start with you.
Yeah, my name is Mark Tyler. I work for Auramet, which is a metal trader out of New Jersey, but with operations, with offices around the world in South America, South Africa, and now in London, also in Toronto and Australia. Our primary aim is to look for metal that we can trade, but in addition to the trading operations, we have an advisory business, but more importantly, a fund which we use to invest in short-term loans and structured financings, bridge loans, possibly the longest tenor is about 3 years, but at a relatively small scale, sort of $20 to $30 million. Primarily in precious metals, but we'll also have a look at base metals as well on a global basis, in fact.
Thanks, Mark. Adam?
So I'm David Orme. I'm one of the founders of Sandstorm Gold. We're a North American publicly traded streaming and royalty company. And we've deployed close to $500 million over the last 7 years on a variety of either producing assets, development assets, and even exploration assets. We focus primarily on precious metals, but we often get some base metals alongside of that as well. We even have purchased some diamond royalties. We are investing worldwide, although most of our investments tend to be North America, South America. We currently have plenty of capital, and in even just the last 24 months, I think we've added close to 120 different assets into the company's basis between streams and royalties.
Thank you. Adam?
Hi, my name's Adam Howard from EBRD. EBRD is a development bank based in London. The bank invests around 8-9 billion euros a year in 64 countries, mainly in Eastern Europe and North Africa. And within that pool, we do around 250 million a year in the mining sector, which is a mixture of debt and equity. We take some small equity positions, and we have a focus mainly on post-pre-feasibility study, spade-ready projects.
Okay, thank you. Maybe I'll send a question out to the streaming specialist and maybe give us a little bit of background. It's certainly an area of finance that has evolved quite a bit, but what are the changes that you've seen sort of in the last 5 to 10 years in streaming, but in finance and maybe specifically early stage financing?
Sure. Well, even before Sandstorm, I was involved with Silver Wheaton, which were really the first public company to deploy streaming and royalties as a way of really companies raising capital, particularly in that development stage of assets. So I've really seen how it has evolved. It still is, I think, considered by many people, relatively new way of financing projects and financing the mining industry. So we have seen it evolve. We've seen it done very poorly, which were some of the deals that even I was involved in at the very beginning, to see it get a little bit more refined. There really are, I would say, 5, I think, mature, large streaming companies and royalty companies worldwide. And over the last decade that we've really all been operating, we've come to realize which one of our strengths, where we set our strengths, what sort of niche that we fit in, and really how you create the most effective type of streaming and royalty financing. So, and many of us have begun to really kind of cooperate, much like how banks work to syndicate deals. We've been syndicating streaming deals. So still, the bulk of the capital that gets deployed in the streaming and royalty space is for those very large cash-flowing deals. But as we've seen over the last several years, there has been a real vacuum of capital available to more early-stage projects and even in the exploration space. So especially with us at Sandstorm, we have been able, and we've been looking to really kind of fill that gap, to really help find the best and the most productive and most efficient exploration companies and their projects to help them finance them along because of this, I think, vacuum of capital for those types of companies.
Yeah, very, very good. So, because there's definitely been a void, the shift out of the brokerage firms and the retail side not being there to fund the early stage exploration. There's certainly a void there. What about from the development bank side? What do you like about that space? Are you involved in that portion of financing from the development bank perspective?
I think I'd echo that. I mean, there's been funding sources have really dried up for the juniors, and we've tried to sort of support that area in our countries of operation, which, as I say, mainly Eastern Europe and North Africa. So we have done grassroots exploration financing. It's typically on an exceptional basis, but when we do it, we try and co-invest alongside other entities. And so there are two things we're looking for there, which is a long-term strategy for the program rather than focus just on next year's drill program. And then also co-investing along an entity that's taken a project through that same cycle before, all the way through exploration through to production. So we've done that in Mongolia recently. We financed a small gold exploration company there, and another one in Armenia as well. And we've already tried to sort of fill that gap in the market in terms of funding sources.
Okay, very good. Move down to Mark. I'm going to ask what changes have you seen in recent years that you think are positive with regards to finance, or things that are you see coming down the pipeline as innovative methods of financing through the supply chain?
Yeah, well, I think the biggest change really has probably been the exit from not only from the junior space and the exploration side, but from the junior space and from the financial institutions, from the banks and those sort of people. They seem to have left the market. But I think the people that have come in to fill the gap have been guys that have got more interest and a longer history in the mining space, that know the industry better than people who sort of haven't been in it and come and go very quickly. So I think the positive side of that is if you're getting finance now, you're getting it from people who understand the industry, who are probably a little bit more patient and will look at things with a long-term view rather than just to get in and out quickly.
Okay, very good. Folks, just feel free to ask questions anytime. Jump in. One up front here.
Yes, on the royalty streaming type company or project, to what extent, well, what are the returns and the risk over the last few years? To what extent do you, say, benchmark over a certain rate and therefore hedge out your commodity risks? And I suppose a supplementary question to that, have you ever considered tiering or breaking up your return streams into a more risky and less risky aspect?
I don't think we would look to break it up. I mean, being a public company, in terms of hedging, typically, I think we're perceived primarily as a precious metal streaming company. So as a result, we're not going to expose any of our precious metals to hedging. Some of the base metals we'll look at hedging potentially for them to really kind of lock in a price on some of that copper and zinc production that we receive from a number of their different mines. But for the most part, our costs as a streaming company, our ongoing costs are very limited. Our all-in sustaining cost of the ounces gold equivalent ounces that we sold last quarter are about $250 or so per ounce, including really our G&A. So for us, there's not really a lot of point to lock in that price. I think shareholders want to have that exposure into the precious metal side. But copper and zinc, sure, if it makes sense, but that's really a very small percentage of our revenue. In terms of risk of the projects, certainly we do have a very large range of risk. Almost all of our cash flow comes from mid-tier and senior gold companies. But I think a big strength that we have is that we do have a great deal of the 171 assets that we have. Many of them are exploration stage, various different stages of exploration. But I think for us, that's a tremendous amount of upside for us. We only really get valued in the bulk of the market really based on our cash flow and our perceived NAV. However, in different parts of the cycle, which we haven't seen for quite some time, we'll get valued, especially as a royalty company, on the optionality of those underlying assets. A lot of people ask me, what turns on at various different prices. And so that's what's been effective for us and why we've really been pursuing that part in terms of actually number of deals. When we come to a conference like this, which is filled primarily with exploration companies, I mean, it's an absolute hunting ground for me to find that next interesting exploration project, because we as a streaming company can provide them equity, and we can also purchase a royalty, relatively small royalty, and it's not going to get valued in the market, in our hands. But we're able to really kind of throw it in that basket of things, and then as they progress and push forward, eventually we're able to really kind of point at assets that are potentially going to be adding a tremendous amount of cash flow for a very relatively low price at the beginning.
Does that mean that, or have you, I don't know your company, I'm sorry to say, but would you issue debt, which would be another, which would obviously have a margin, as a way of answering the first question?
Well, I guess the short answer is that we don't issue debt. I don't really see our streams as debt. They're not really structured as a debt piece. I mean, we often get security alongside of them. But they're really meant to be pieces where you take a lot of that production risk alongside of your actual partner on these assets. We finance almost entirely, or we have financed almost entirely through equity in the past and through existing cash flow. Our company will produce about $50 million in cash flow per year. And almost all of that is either earmarked in share buyback programs or just deploying it into new transactions.
Thank you, Dave. Mark, question with regards to on the trading side, what do you like? Are there specific commodities that you like these days? Maybe give us some background there.
We really just look at the precious. So I think gold and silver have been relatively stable over the last few years compared with some of the gyrations we've seen in the base metals. So we're quite comfortable with that. I think we have a big exposure to the platinum group metals. We trade a lot of platinum group metals. And obviously the one that's performing really well is palladium at the moment. The others, the two big ones, platinum and rhodium, seem to be really struggling. But I mean, the relative exposure, there's only a few South Africans that produce those, and then autocat recyclers. So I think the exciting thing in the commodities is probably palladium at the moment. That seems to be the one that's going, and there's some exposure outside of South Africa.
Yeah, very good. I'll ask this question of you, Adam. In from my side of the business, the projects business, we've seen quite an evolution from the collapse and the overruns of the projects of the 2010 to 2012, and a shift from the EPCMs to everything moving to an EPC favor. We're seeing that's sort of moving back, but I wonder from a finance perspective, a risk perspective, how does the financial community see the project contractual models that are out there, and what's your appetite for financing in those various models?
We talked about this a little bit yesterday. And, we've done conventional EPC contract financing for mining contractors, and a fair bit of that in the past. But I think there's potentially some room for new structures. I mean, build, own, operate model works very well in other sectors. It hasn't really been applied on a big scale across the mining sector. And in terms of the EBRD, we do a lot of focus on energy efficiency and water efficiency projects, which fits our mandate. And so build, own, operate projects on either tailings facilities or perhaps a little bit more complex on copper con processing plants is something that we've tried to look at. There haven't been a lot of them coming to market, but for for juniors that are struggling with financing, outsourcing parts of that to different providers is quite an interesting model for us.
Yeah, you'd be moving it off the capex side of the ledger to the opex, and may help out. Very good. With regards to one of the questions for the panel was financing from the supply chain. Wondering if you and anyone you feel free to answer. Are you seeing any changes, any new potential financing coming in from either the financiers? I've personally seen the export credit agencies becoming more aggressive with supporting their various country technology suppliers. We've always had the traditional big fleet financing from the Caterpillars of the world, but are you seeing anything on the supplier side? Feel free to jump in.
Well, from my experience, which is really more of a capital markets experience, it's been more of the lack and who has removed themselves from that whole financing equation. Especially in Canada, we've had over, at times, 4,000 different exploration companies. And most of those, even just 10 years ago, or even just 7 years ago, they were financed by these vast networks of brokers that were really on that speculative risk side. But in that last, let's call it 7 to 10 years, the landscape has changed tremendously. And those brokers have been overregulated. The small independent brokerage firms, because it's become very expensive to try and operate your proper compliance department, they've either consolidated or they've just disappeared off the face of the earth. So you're really kind of faced with a whole industry that up until 7 years ago was really looking for that speculative risk capital. Somebody with a good drill program, an interesting exploration program, would go to the floors of either Canaccord or Haywood or Dundee and talk to their brokers or find a broker. They'd figure out how to raise them $5 to $20 million, but that's all but evaporated. And in Canada especially, a lot of the money has flowed into these cannabis companies. Any of that speculative risk capital that's there, or else has gone into cryptocurrency, which has really laid bare. And I think that's been the biggest change for companies in our space and public companies in our space, is lack of ability to access that exploration speculative risk capital.
I mean, do you not think that that's sort of like just rewards? I mean, I think people collected quite a lot of money over the period from sort of 2001 to 2011 on speculative investments in the mining industry that, I think there was an oversupply of project at the end of it all, rather than, it being a shortage of capital, I think, too.
Well, yeah, I think you're absolutely right. I mean, there's always very poorly run. I mean, there's no shortage of poorly run Canadian exploration companies. But at the same time, too, this is really a fundamental part of how the industry finds their new projects and their next projects. And that's something that we've noticed in the end of 2015, is that some of these best exploration results that had been realized in years were getting completely ignored by the market, whereas even just 5 years prior to that, in 2010, they would have been jumped upon by any number of different brokers or banks or independent banks jumping into that. So sure, many of them deserve to really not receive that capital, but I mean, this is how we make discoveries. I mean, I haven't seen Newmont or Goldcorp or anybody from Barrick wandering around the floors here looking at the exploration companies. So, and trying to look at their projects or finance their projects, and they're not discovering them themselves. So as a result, we've always relied on the exploration companies to be the efficient ones at finding those next mines in the industry.
I think what we're seeing though is guys like yourself are coming into the industry, guys that understand and know and have the skills to evaluate a good company, rather than some guy who's a retail investor and is just working on the basis of what his broker tells him. So I think you're seeing much more skill in picking companies and finding the ones that will go ahead.
Okay. Considerations for deploying capital from the European bank perspective?
Yeah, I guess it varies by institution. I mean, for us, there's three legs to the stool. We're on the technical side. We're looking for the PA or PFS in place, and then the environmental studies. On the financial side, on straight equity. We're typically looking at a project that we can underwrite at 2 times money. But more important than that is the management and the partners that have taken a project through the entire curve in the past. I think that's the sort of main focus when we look at new projects. And then we have a third leg to the stool, which other parties don't have, which is our development mandate. So we're typically looking at money into the ground that's either bringing new skills or new standards into the market where the project is at. Those are the 3 main focuses for us.
Very good. Mark, how about yourself from the Auramet perspective? What are your key considerations for deploying capital into the current market?
Yeah, well, I think the important thing for us is it needs to have a time horizon. We've got a relatively short-term focus, so we don't want to stay in for much longer than 3 years. So we look for being able to do those sort of things so to get somebody into production relatively quickly. If there's a long-term financing required to keep the guys on production for 10 years, I mean, that's not the sort of business we look for. So primarily we're looking to do short-term, but relatively high risk. You know, we'll take bridge loans and those sort of things as well.
And then really for Sandstorm, I think, and I think this applies to many royalty and streaming companies, is the ability to really kind of act quickly. I think that's our big advantage when working with many of the types of companies you'll find here and even the mining companies, is that we're able to put together packages very, very quickly. We're able to be relatively flexible. The one thing that we've learned as a streaming company collectively is that you need to create an instrument that's going to still allow your partner to attract equity into it, but still be very, very flexible. You know, all of us as a whole, our investments end up getting valued basically on an NAV or net present value to these assets. So that allows us to have, I think, more flexibility than many banks. Our money doesn't come as debt. It's sometimes, and it's easy for us to postpone these as long as we can still justify that the project has the NPV that we paid for it. And that will help satisfy our investors. So we can be flexible. We can be very, very quick on these sorts of things. And we can invest in a variety of different stages of projects.
Is there any questions that people like to pose to our guests?
General question to you guys. I mean, none of you are the traditional financiers of junior exploration as we saw through the super cycle. As you mentioned, the retail investors who are getting promoted by the brokers promoting particular ideas. Are you suggesting that there's a structural change, that there is no avenue for the dreamers to get financing to get their project going? Or does that not really matter? The good projects will find money irrespective, and it's the dross that will just disappear off the side.
It's my impression that it's kind of both. I think the successfully financed exploration projects and companies have been, I think, by really kind of passing the hat amongst the Ross Beatties and the Lucas Lundins of the world to their associates to be able to find assets. There's been some strategic investments, but still those tend to be in the more well-known names. I do think, and I think constantly see geologists that have good ideas, interesting projects, but just can't find any type of financing, even to do very, very basic projects and basic financing. I know that there's companies right here that still struggle to, even though they've been around for years, they've been working on these projects for years, maybe I think from the market's perspective have taken missteps in how they've allocated capital in the past. But I still think their projects are worthy of getting exploration dollars that they're having a tremendous amount of difficulty accessing. You know, it tends to be a very specialized, I think, group to be able to raise money in this in this market.
I think what you say is correct, and what we've seen is an exodus of short-term money from the market, and equity capital markets aren't really funding juniors. But what's left is much longer-term providers of finance, and I think that fits the exploration business. So we're very long-term in terms of our investments. We'll look post 5 years on most of our projects, and so when we look at it, we diligence the project on that basis. And I think for the type of business and exploration funding, that's not necessarily a bad thing. And there's a lot of money on the sidelines at the moment in terms of private equity funds that have been out there to market. They've raised big funds and haven't necessarily been able to fully deploy them. So I think for good projects, there's good long-term money out there to support them.
I think the other thing is there's probably money for dreamers out there, but you have to dream in fashion. So if you're dreaming about lithium, I think you can raise quite a lot of money. But I think if you're dreaming in gold, you'd be struggling.
Yeah. Yeah, and there certainly has been, in Canada, there's been a structural change from a regulatory perspective. It's been much more difficult to raise up money because of the rules around accredited investors. But what has happened also in Canada is the flow-through share program they've expanded what is allowable as an expense from the flow-through share perspective. So that's given a little bit of life to it, but it is with the regulatory environment that is there. It's difficult for individuals other than those of high net worth to invest in junior mining. So the dreamers who aren't junior miners but who are hoping to make a lot of money in junior mining by betting a few $1,000s on a private placement just can't do that anymore. So, any other questions or comments? And if not, we'll wrap it up. If you guys.
Yeah, quick question for David. How do you, looking at your company as an investor in your company, what do you benchmark yourself against? Are you benchmarking against the gold price, juniors, mid-cap companies, a large index? How would you project your performance as a company?
Well, royalty and streaming companies are a little bit of a subsector themselves within it. You typically will see, I think because the royalty and streaming companies tend to have a much more reliable cash flow, they get valued at a much different, a much higher multiple. You know, as you can imagine, where if you were to look at Barrick or Goldcorp and seeing them getting valued at a 14 times cash flow, well, that's pretty tough to swallow that, because you know over a 14-year period, there's going to be multiple years in that where they aren't going to have any kind of cash flow at all. Whereas streaming companies, because essentially your margins, your costs are essentially fixed, the idea of being able to imagine that cash flow over 14 years is going to be positive and pretty excessive. I mean, in fact, there have been points in the cycle where the 5 really major public mature streaming companies have produced a cumulative cash flow that's higher than the rest of the entire industry combined. So we do get multiple. So if there was any kind of benchmark or anywhere that we're trying to look, it's really where we fit amongst the rest of those streamers. I don't know if it's really makes sense to really compare us to other gold companies or other mining companies. It's just really kind of amongst those public streamers is probably the best way to benchmark ourselves.
Okay, thank you. Well, we have to wrap it up. I want to thank you all for participating. These 3 gentlemen will be wandering around the hallways here, so please feel free to snag them if you have any more questions for them. So once again, thanks to everyone here.